exactly 1 o'clock here, Pacific, or maybe 1:01. People are starting to come in, so I'm just going to do a little song and dance. Now we're just going to wait a little bit, give people a few more minutes, technical issues and all of that, and more or less get started on time here. So welcome. By the way, I'll be introducing this later in the webinar. There will be a question and answer section here. So depending on the device you're using, whether it's a computer, whether it's an iPad, an iPod, a Macintosh, whatever it may be, the Q&A button may be different on your device than on mine. On mine, it's on the bottom of the screen. There's a Q&A button we can use to submit. But again, you may have to sort of swipe off the screen or something like that. But if you'd like to sort of take a look for where that might be now, as a course of this presentation, if you have questions, you can submit them and we'll curate them a little bit and try to get to as much of them after the formal presentation for a few minutes. You can look for that now. Let's see, well, I promised I would not use my laser pointer. I think I may use my laser pointer for this presentation, so. And we have an East-West Coast group of people here. So some of you will be joining us just after lunch. On the East Coast, it's 44 o'clock. Either way, the presentation portion of this will end at about 1/2 past, after which I'm going to open it up for Q&A and essentially stay around as long as people want. If there are questions I cannot answer that are either too technical or would take too much time within this forum, I'll have my contact information here at the end too if you want to send an email or a phone call, and I'll promise to follow up if you ask me something. And Liam, I will wait for your word when it's good to go, kind sir. Good to go. Okay, perfect. Perfect. Well, welcome everybody, and thank you all for coming here on a either early afternoon or a later afternoon here if you're on the East Coast. My name is Frank Napolitano. Okay, it's right here. I'm a senior advisor at Sensible Financial. Some of you may know me from Sensible Financial. I'm also a board member of Freeflight Exotic Bird Sanctuary. Others of you here on the call may know me by means of Freeflight Bird Sanctuary. Today's webinar, I'm calling it Smarter Giving, Tax Efficient Strategies for Charitable Donations. I'm going to talk about 3 simple strategies people can use to potentially maximize tax deductibility of charitable gifts. And I'm going to call them simple strategies because they don't require use of an attorney or a special instrument like a trust or something like that to affect them. So, and while the strategies I'm going to talk about today are generally applicable, right? They're applicable to any sorts of public charities. I am extremely biased when it comes to charities, and I'm going to say a little bit about our sponsor here, Freeflight, with whom I have an association. So Freeflight Exotic Bird Sanctuary. It's a nonprofit exotic bird sanctuary located in Del Mar, California, just about 20 minutes north of San Diego. The organization is dedicated to educating the public about parrots, rehoming relinquished birds when possible, and providing a permanent sanctuary for birds who need it. Unless you think I'm winging it, it's a bird pun. My colleague Lauren Alvarez is also here on the call. Hi, Lauren.
Hi, everybody. Thanks for joining us.
Lauren's also a board member. She's our communications director of Freeflight. She'll be joining me on this call, sitting through it, and at the end, when it comes to Q&A, if you have any specific questions about Freeflight, Lauren's going to go ahead and answer those questions. So, by means of this presentation, I've sort of scheduled 30 minutes for the presentation portion of the deck. There's, I think, about 15 slides here. And I set aside 15 minutes at the end for Q&A. So if through the course of this, I'm talking about something, not explaining something clearly enough, or a question arises, you can look for either at the top, at the bottom, it may be a slide, depends on your device, but there's a button that says Q&A. And if you use that, if you type a question into that, we'll, my colleague here, Bonnie, will be sort of curating those things. We'll try to answer as many questions at the end as possible. And if we don't get to it, don't worry, I will have my contact information on here, Freeflight's contact information if you send us an email. I promise to follow up. And once again, thank you for joining us. So just a little bit about myself here, and this is Midori. If you've ever been to Freeflight, you may know her. She's often making telephone sounds and sort of other her favorite sounds, and she's very friendly little fellow. I always think about her as a female, although I don't think she's technically been sexed. So I really hope I'm not using the wrong pronoun. A bit about myself. I'm a senior financial advisor, Sensible Financial Planning. We're a fee-only financial planner, offices in San Diego and Boston. I'm originally from the East Coast, so I did my undergraduate degree at Harvard. I took a few years off, came back to Boston, got my law degree at Boston University. And because even after that, I hadn't figured out what I wanted to do. I've been a financial planner for 10 years. So my bona fides in terms of financial planning, I'm a certified financial planner, and also what's called a chartered financial analyst charter holder. In addition, importantly, to the work that I do as my day job at Sensible Financial, I'm also a board member at Freeflight as Bird Sanctuary in Del Mar. That's my bias, and I'm also on the fundraising committee there. In this webinar, in this little talk here, I'm going to try to cover three things. So I'm going to begin with an overview of how charitable gifts can reduce tax liability. I'm going to give sort of taxes 101, very simplified version of it. We'll talk about sort of where charitable giving fits in to the tax calculation. I'm then going to talk about some recent changes to the tax code, recent sort of important changes to tax code in terms of how charitable giving has changed over time. There's the two laws I'm going to point out in particular, and I'm going to finish this webinar with sort of three strategies that can be applied to charitable giving in general, right? And like I said, I'm a biased actor here, and I promise at least a few birds are going to show up by the end of this presentation, because even though this is a presentation about charitable giving, the tax deductibility of charitable giving, the giving part of it is very important. And if you are giving to a charity like Freeflight, right, what you do is very important to us, to the birds, right? Because birds got to eat, and Midori gets very upset if she doesn't get her bird food. And let me also just emphasize here at the beginning, right? This is the topic is charitable giving and tax deductibility of charitable giving, but I'm a number of things, and I've trained in several fields, but I'm not a tax accountant. This webinar really is meant to be educational and of a general nature. So please, nothing in this, do not interpret anything in this webinar as specific tax advice for you. Taxes are complicated, as you may know. And if after this presentation you were sort of find some interesting ideas here, please consider this as sort of a springboard for further exploration, either individually or with the tax accountant, with the CPA. So let's begin with sort of the tax calculation. How do taxes work? And as I promised, this is a very simplified view, an oversimplification of taxes. Here's how taxes work in general, right? Sort of a high view. We begin with gross income, and I'm just using example numbers here throughout this deck. This is nothing specific or nothing magical. Begin with gross income. We subtract from that deductions, and in the tax code today, For most people, that's going to be the standard deduction or itemized deduction, the higher of the two. The difference between the two is taxable income. And then to arrive at your tax liability or taxes due, you multiply taxable income by some rate. I'm just using an example right here, 30%. And taxable income times your tax rate equals taxes due. This is the simple tax calculation, okay? So how do charitable contributions fit into this mix? Well, charitable contributions can reduce taxes in two ways, actually. The first is perhaps something you may be familiar with. So essentially, charitable giving can increase deductions if you're able to itemize deductions today. In this example, if you gift $20,000 to charity, right? This could be one large gift or a year's worth of giving. If you made $20,000 of charitable donations in a year, you would add that to your deductions. So long as you're itemizing, that increases deductions by the value of the gift. It reduces taxable income by the amount of the deductible gift or gifts. And to calculate taxes due or your tax liability, again, we take your taxable income, multiply by the tax rate, and that is taxes due. This is an important point. Charitable donations the deductible charitable donations, excuse me, do not reduce taxes dollar for dollar, right? There's a $20,000 gift. It did not reduce taxes by $20,000. It reduced taxable income by $20,000. You can approximate the tax savings of a charitable donation by taking the amount of the gift, in this case, $20,000, multiplied by the tax rate. $20,000 times 30% is $6,000. That's the tax savings. Okay, and you can see that as the difference between here on the left, there's no charitable giving, and charitable giving here on the right, the difference between $22,500 and $16,500 is $6,000. That's the tax value of the gift. So that's one way in which charitable giving can reduce taxes. And there's a second, I'd say lesser known way in which charitable contributions can reduce taxes. So charitable contributions can also reduce income. We don't even have to deal with deductions here, whether you take the standard or itemized deductions, but certain charitable deductions can reduce gross income dollar for dollar. So same premise, right? A $20,000 charitable gift. If that gift is able to reduce gross income directly, well, you reduce $100,000 by the value of the gift. Gross income is now lower by $20,000. We subtract the same deduction, and we're left with $55,000 in taxable income. And again, we've reduced taxes by the value of the gift. A $20,000 gift times 30%, $6,000 is the difference between taxes due in these two scenarios. So in both cases, and I'm going to show examples of each, but in both cases, assuming you can itemize your deductions, and assuming no sort of special tax rules apply, which is possible, the tax code is complicated. But given these very simple set of examples here, whether you give to charity by reducing gross income directly or by increasing deductions, the tax effect is the same. You're reducing taxes by the amount of the gift multiplied by your tax rate. Okay. I want to talk to you briefly about some changes in the tax code that have made charitable contributions both more and less difficult. So two changes. And this is important, right? That the tax code is constantly changing. There's a debate going on right now about whether and to what extent the tax code may change yet again. But in today's presentation, I'm really just going to talk about two laws that have had a pretty significant impact on charitable. Okay, so the first is Tax Cut and Jobs Act, 2017. Tax Cut and Jobs Act was a very large tax bill, had ramifications throughout the tax code. But for purposes of this conversation, I want to focus on the effect that it had on deductions and many of you on this call may be aware of the fact that you have been able to claim deductions prior to 2017, but post 2017, it became much more difficult or maybe even impossible, due primarily to what's sometimes called the $10,000 SALT cap. SALT is just an abbreviation for state and local taxes. So prior to the Tax Cut and Jobs Act, if you lived in a high tax state like California, like Massachusetts, like New York, you were able to deduct against your federal income state and local taxes, essentially with no cap. Today, with that $10,000 cap, millions and millions of Americans who had been able to itemize are now no longer able to do so. And that makes charitable contributions at least more complicated for a lot of people. Prior to 2017, you were able to simply add your charitable contributions to the rest of your itemized deductions. Well, then you got the full benefit, potentially the full benefit of those charitable gifts. Much more difficult post 2017. The second piece of legislation I want to talk about is a much lesser known piece of legislation, but the Protecting Americans from Tax Hikes or PATH Act of 2015. Again, there were a lot of things that this law did, but for purposes of this conversation, for what's most important is that in 2015, the Congress decided to make what are called qualified charitable distributions a permanent part of the tax code. Prior to this, it would come up every year and they would decide whether or not to make it part of that year's tax code. But in 2015, they said qualified charitable distributions are now part of the tax code. And what they are, or what they enable some people to do, is subject to certain conditions. If you have an IRA, you have a pre-tax retirement account, and you're today anyway, 72 or older, you can make contributions directly from your IRA to a charity of your choice, and those contributions will directly come off of gross income. And I'm going to show an example of how this works. These are the two important tax acts I'm going to talk about here, tax ramifications. And the first one, like I said, is potentially burdensome, right? And that makes Red angry, right? Because Red wants his bird food. And if you make it more difficult to give to charity, fewer people will potentially do so, and you wouldn't like to see Red when he's hungry. However, the PATH Act of 2015 should make giving to charities easier, should increase the amount of dollars that charities get, all else equal, and Scamp and her friends love that. That means more bird food, or whatever your charity of choice is. That should be good for charities. So we talked a little bit how to calculate taxes, how charitable deductions affect the calculation of taxes. Here are two laws to keep in mind, how they've changed the tax code in recent years. And I want to talk about three strategies now, in light of the changes in the law, that can allow people with some effort to be able to sort of get the full benefit of tax deductibility, or at least reduction in taxes with their charitable giving. And the first strategy I'm going to talk about is donating appreciated stock. Appreciated is just a fancy word for saying stock that has increased in value since it was purchased. And here's how this strategy works: is if you own stock with gains, appreciated stock, in a taxable investment account, in other words, not an IRA, not a 401k, but what's sometimes called a brokerage account. If you own stock which is grown in a brokerage account, you can gift that stock directly to charity, and that can reduce taxes in two ways. So first is the value of the gift. Again, as we saw earlier, if you were able to deduct charitable donations from your taxes, well, the value of that $20,000 gift I used earlier is able to reduce taxable income and reduce the taxes by the amount of the gift multiplied by your tax rate. Okay, we've seen this already. But I say that donating appreciated stock is doubly tax advantageous. There's a second element to this, which is the unrealized gain is never taxed. It sort of magically disappears by means of the IRC, the Internal Revenue Code. And I'm going to illustrate this by showing you how equal gifts of cash or appreciated stock, what essentially the tax differences are between those two choices. And I'm going to use, as an example here, I'm going to use Sally. And Sally is a kind-hearted woman, and she's thinking about charities that she may want to give to. And on this case, she's thinking about some birds. Okay, maybe she'll write a check to Freeflight or donate stock to Freeflight. Let's see. So let's assume that Sally can make her gift in one of two ways. She can make it in cash, or she can make it in stock. Let's first look at the gift of cash, because this is easy to illustrate. How would this work? And so Sally begins with a check. She writes a $20,000 check to her charity of choice. Let's call it A Bird Sanctuary in Southern California. That charity, step 2, they use that check, cash the check, and they go and buy bird food, right? What happens the following year? Well, Sally, who's able to itemize in my example, she claims her $20,000 deduction, and that reduces taxes by $6,000. Again, the value of the tax savings is not the value of the gift. It's the value of the gift multiplied by your tax rate, or in this case, my hypothetical tax rate of 30%. 20,000 times 30%, $6,000 in taxes saved. Great. What if instead of giving $20,000 check, Sally has an investment account? She has a stock account, and the stock she has in there has grown. Well, first of all, this makes Sally happy, right? So Sally gives money to the bird. She's able to write up on taxes. That's a good thing. But let's assume Sally also attends this webinar, a webinar like it, learns about donating stock. Well, what could she do in that case? Steps are quite similar. Step 1 is she has $20,000 in stock shares. I don't really know what a stock share looks like anymore, but let's pretend this little picture is a stock share. She sends the stock, not the cash. She sends the stock directly to some charity. The charity can't buy bird food with stock, so they liquidate the shares, they sell the stock. There's no tax ramification to the charity. There's no negative impact on the charity here. I think it's really important. And they use the cash to go buy bird food. What happens next, though, is different. So the following year, Sally's doing her taxes. As with the cash gift, she's able to claim that $20,000 deduction, and that reduces her taxes by $6,000. Additionally, she avoids, in my example here, $10,000 of capital gain. So again, her stock has increased since she purchased it. She bought it for $10,000. She left it in there for a long time, and now it's worth $20,000. Well, that $10,000 of gain, which would be taxed, which she would owe $2,000 on in my example here, it magically disappears by gifting those shares, those stock directly to the charity. In this case, instead of just having the $6,000 tax savings here, she gets an additional $2,000 savings in tax, which from Sally's perspective is great, right? Even better. So to summarize here, strategy number 1, right? In which cases would donating appreciated stock, or could it be a good idea? Well, if you have appreciated stock in a brokerage account, in an investment account, if you're thinking about gifting cash versus gifting stock, this is probably a superior option. Additionally, the charity that you want to gift to must be able to accept shares. Not all charities can. Very small charities may not have a brokerage account set up to accept the shares, but you can find out if your charity does by calling them up or checking their website. Good news, Freeflight is going to be able to accept stock. In the past, we had to tell people we weren't able to do this, but we'll be having an account open by the end of this month at Vanguard, and we'll have the information on our website, and we'll be sending out information to people on our mailing list. So the third aspect of donating stock, under which circumstances could this make sense? Well, if you itemize taxes, you don't have to itemize taxes, of course, but it increases the value of the gift. So imagine Sally gifted the $20,000. but the 20,000 wasn't enough to get her into itemized tax land, right? This sort of standard deduction was still larger than her itemized deduction. Well, saves $2,000 on the unrealized gain. That's still a form of tax saving, but she's losing out the value of the gift. She's losing out the value of the charitable deduction. That's an issue, and that leads us sort of here to strategy 2. And I'm going to introduce the idea of a donor advised fund. And with a donor advised fund, it's a special type of account, and it allows people who might not otherwise be able to itemize by itemizing, essentially by lumping several years of giving together, by making a tax decision in 1 year and making the giving decision or giving decisions over time. So let's take a look at donor advised funds. This is our second strategy. And I'm going to talk about how essentially, if you're not gifting enough to get the benefit of the itemized portion of your taxes, how you can do that with a donor advised fund. So first of all, what is a donor advised fund? Okay, a donor advised fund, it's a charitable giving vehicle. Think about it as an account sponsored by a public charity. It allows you to make a contribution to the account, be eligible for an immediate tax deduction, avoid capital gains on stock. You could gift cash, but it makes more sense if you have it to gift stock, and recommend what are called grants over time to your IRS qualified public charity. So the DAF kind of sits between you and your charity of choice. And I'm going to show what that looks like just in this next slide. So how does a donor advised fund work? Again, I'm going to return to the example of Sally. Hi, Sally. So recall, right? Sally decides to give $20,000 of stock to her favorite bird charity. Now, imagine that $20,000 gift was not large enough in Sally's circumstances here, the way she's filing, to get the benefit of the charitable deduction, right? Because again, your itemized deductions have to be larger than the standard in order to get the benefit of the deduction. Well, here's something she could do. She could choose to make a gift of $80,000 of stock. 80 is not a special number. I'm just saying several years worth of giving in 1 year to her donor advised fund. What happens? Well, she gets a tax deduction in this example for $80,000. Sally will definitely be itemized this year, whether she's filing individually or jointly. And if she's donating stock, she doesn't have to, but if she's donating stock, she also avoids capital gains. She now has a donor advised fund with $80,000 in it. Okay? And what she can do over time is make those gifts, which she was planning on doing anyway, to one of her favorite charities. The difference being, had she done $20,000 every single year, she would not have gotten the charitable deduction, or maybe would not have gotten the full amount of the charitable deduction. But by lumping together several years of giving, by essentially doing a large gift to a DAF, donor advised fund, in 1 year, and granting over time, she's now able to itemize and get the benefit of giving to charity on her taxes. I like to think about the donor advised fund as a way of separating the tax decision from the giving decision. Right? Even though this itself is considered the gift, for Sally, it's really giving to her favorite charities over time, which is the charitable part of that gift. And I should just mention, right, that a donor advised fund, there's lots of donor advised funds out there. We see a lot of our clients using Fidelity. In fact, Freeflight gets a lot of checks from Fidelity Charitable. Fidelity has their own donor advised fund, Vanguard, Schwab, lots of these large custodians manage their own donor advised funds. So using a donor advised fund, under what circumstances might this make sense? Well, if you give to charity, but keep that salary for a moment, if you're not able to itemize taxes because essentially you're not giving enough in 1 year. You could bunch together several years of gifts into one, get the deduction, and then make grants over time. A donor advised fund might also make sense if you have appreciated stock. You could gift cash, that's perfectly fine. But again, if you have stock, the benefit of the stock is that you get not just the charitable gift, the value of the gift, but also the elimination of that unrealized capital gain. Another reason why this might make sense, and this is a little more nuanced, but if you are currently in a high tax bracket and you anticipate being in a lower bracket in the future, the benefit of charitable giving from a tax perspective is high today, and it's not as high in the future. Again, this could be a good argument for bunching gifts, doing several years worth of gifting in a year in which you sold a house with large capital gain, or in several years leading up to retirement before we anticipate having very low income. It gives people the flexibility to separate the tax decision from the giving decision. Okay, the last strategy I want to talk about here is what's called a qualified charitable distribution, or in finance, because we love our acronyms, sometimes called a QCD. Okay. Now I want to just remind us what the tax formula is here, right? Gross income minus deductions equals taxable income, multiplied by our tax rate, and that's taxes due. The last two strategies, we're primarily talking about how to increase deductions if possible, right? And if you can give stock, well, that lowers taxes even further. With a QCD, or qualified charitable distribution, you are modifying taxable income here at the highest level, gross income. So here's how a QCD would work. You would instruct your IRA custodian, say Fidelity, Vanguard, TD Ameritrade, to write a check directly to a charity. This part is very important. Take the $20,000 out, it becomes part of your gross income. But if you instruct your custodian, your IRA custodian, to write the check for you, made out directly to the charity, it bypasses gross income completely, and that check is cashed by your favorite charity, or Freeflight, perhaps. And again, from a numbers perspective, here's how it works. That $20,000 check or checks, we do this multiple times throughout the year, reduces gross income right off the top. It does not matter whether you take the standard deduction or you itemize. The income comes right off. It does not appear in a 1099. It's like it never happened. And this is really efficient. I say efficient, right, because the gift comes off of gross income directly. Anybody, any eligible person can make this type of gift, and it's really simple from a tax perspective. You do not have to track your gifts over time and things like that. You have to keep records, of course, because it's the IRS, but it's a very efficient way to give to charities and to reduce taxes in a year. And again, just to repeat, the value of the tax savings is the same as a deductible gift. It's the value of the gift, $20,000, multiplied by the tax rate, or $6,000, is the difference between taxes due between column 1 and column 2. Now, the people who can take advantage of QCDs, it's a smaller set of people. This is important, right? QCDs can be a good choice for you if you don't itemize, okay? Because it doesn't matter. You don't have to worry about gifting a lot of money in a single year in order to get the itemized world. It comes right off of gross income. But in order to make a QCD, you have to be of the age in which the IRS requires you to take required minimum distributions. This thing just changed over time. Today, it's if you're 72 or older. It used to be 70 and a half. But essentially, if the IRS requires you to take distributions out of your IRA every year, you can do a QCD. And the PATH Act, again, has made it permanent. And of course, it's a good choice for you if you plan to give to charity anyway. Right? You have charitable intent. If you have cash in your checking account and you're not sure if you're going to itemize this year, and you have to take money out of your IRA, it would always make more sense to instruct your custodian to do a QCD in the amount and to the charity of your choice. There are some technical requirements here. I've listed them. I will say there are more here than just what I could fit on this little slide. But in general, to make a qualified charitable distribution, today you have to be at least 72 years old. This is very important that the check is payable directly to your charity. You cannot deposit it yourself. It becomes part of income. There are rules around things like maximum contributions, the types of accounts. We're really talking about pre-tax retirement accounts here, predominantly IRAs. And just a note, if you are required to take minimum distributions, and if you are not taking, or if you're not using those dollars, let's say you have extra income in a given year, the QCD can count against your required minimum distributions. It's a way of reducing taxes and sort of not using income that you weren't planning on using anyway. Okay. It's a little more complicated than the other two strategies, perhaps, but again, if you're 72 or older, this can be a really efficient way to give to charities and not have to worry about, am I going to be itemizing my taxes this year? Okay, and I finished in just about 30 minutes. I think I started 5 minutes late, so that was 32 minutes. I apologize. And this is the end of our presentation. I have some information on here. Midori thanks you. I thank you. Freeflight thanks you. Sensible Financial does. I have some information here on if you're interested in giving to Freeflight, here is our EIN, our email address, and our donation website, types of gifts we accept. And yes, we are open today for reservations. My information here, again, I'm going to answer some questions hopefully now, but if there are things we don't get to, you can email me or call as well, and I promise to get back to you. So thank you all very much. I hope this was helpful. Bonnie, sorry, I'm not hearing you. Still not hearing you, Bonnie. If you want to type into the chat, I can read from that. While I'm waiting for Bonnie to get the audio reconnected here, I'm going to answer a question that I get from clients. It's an interesting one. And sometimes we're asked, can you combine the two? In other words, can you take a qualified charitable distribution and put that money into a donor advised fund? Why might you want to do this? Well, gifting out of the donor advised fund is really easy. Typically, you log into an account and you go online. You say, I want to send. Let's say you want to send 50 really small checks. It would be very frustrating to call up the custodian and do this. But with a QCD into a DAF, you could conceivably move $20,000 and go online and have them send out 1,000 checks. One of the limitations of a qualified charitable distribution is that it cannot be used to fund a donor advised fund. So if that was a question you were thinking of, I apologize. That is not available here. Here we go. I have a direct message. This is actually a good question. Right, so I'm over 72. Which strategy is better? A qualified charitable distribution or a donor advised fund? That's good. Now, again, all else equal, if you're itemizing, there should be no difference. There should be no difference if whether you take $20,000 off of gross income or take $20,000 and add it to your deductions, the tax effect should be the same. In the past, again, I'm not a tax accountant here, I apologize, but in the past, there were phase outs with deductions and things like that. So to be safe, most people would recommend doing the qualified charitable distribution because you would always get the full amount. It always came off of gross income. I'm not sure to the extent to which, I'm certainly not sure about things like state tax and things like that, but in the past anyway, the QC was always the more efficient way of doing it. If you were eligible for both, I think that's a great question. That is a sort of a nuanced question for a tax accountant. Somebody like that can really help understand the sort of your individual circumstances there. Here's another one. Are there any age restrictions for a DAF account? No, there are not. There are certain other restrictions in terms of the total amount that you could deduct to charity in any given year, and those numbers differ at a fraction of AGI, and it differs whether it's a cash gift or whether it's a stock gift. Don't ask me why. I didn't write the tax code, but there are no age restrictions on a donor advised fund. You could do it as a 30-year-old. You could do it as an 80-year-old. It does not matter. Again, just to repeat, I think, like with much of the deductible gifts, right, to the extent you can get depreciated stock, it's always sort of a double benefit. So the DAF is a very flexible account. It's a very, our clients really like using them. It's very easy to navigate, at least Fidelity's is. I'd imagine it's similar to Vanguard. But to the extent that you can get stock, especially today, if you own stock, any stock within the last 10 years, it's probably appreciated somewhat, or perhaps a lot. It's not uncommon for us to see stock that's up over 100% for the last 10 years. So, any other questions for us here? Waiting for Bonnie to type something in here.
Hey, Frank, I think Bonnie is going to have me deputized to kind of pull in on questions and stuff.
Sure.
I think you have a couple of questions in the questions bar here. One from Betty, which was as suggestions as to where to open a DAF, sort of going directly to Fidelity, asking about admin fee rate. Is there like a list somewhere of these kind of things?
That's a good question. I haven't compiled a list personally. I know that and first of all, I should mention this too, right? Donor advised funds. Of course, the custodians charge some fee for this. In our experience, it's a very reasonable fee. I would start with the big ones that I listed there. I mentioned Fidelity, I mentioned Vanguard, I mentioned Schwab. I would start with those three, and you're gonna be able to find a lot of information on the DAS website. The major differences are gonna be like if you already have an investment account at Fidelity, it's generally easier to move stock from Fidelity to Fidelity or from Schwab to Schwab or Vanguard to Vanguard. There'll be some differences in cost and fees.
Totally. And I've kind of got a selection of questions coming in for Lauren, actually, about what donations are benefiting Freeflight, how else can people help Freeflight? Is it possible to adopt from Freeflight? Donations of various things like used cars or anything like that?
Happy to answer that, Liam. Thank you again, everyone, so much for joining us today. So at Freeflight, we are a 501c3 nonprofit. We benefit greatly and thrive on the donations of our awesome community, and they come in all shapes and forms. So cash and direct donations, all of this goes back to supporting the livelihood of not only the 40 to 45 parrots who are currently in our care, but it also keeps connections with our natural world accessible and affordable to our local community. It's only $8 a person to come visit right now. So great way to stay involved, inspire future generations of natural caretakers for our environment, and engage in meaningful discussions. So your donations go back in a big way to support birds in our care, our ambassador birds, but also a better future for birds and people together. On the donation of cars, we actually just started a vehicle donation program. So you can check out our website. I believe Frank has it there in his presentation, but freeflightbirds.org/donate. And you can find all sorts of ways. We accept in-kind gifts through Amazon. Even if you have, office supplies or things like that, that you think, I'd really like to see this support a better cause, it helps us out. And we are so, so grateful. And I believe you asked about adoption. Sorry about that. So yes, you can adopt birds from Freeflight. There are some who are living in permanent sanctuary, which means they get to retire. So their nice retirement plan was to come and eat walnuts with us for the rest of their days. But some are deemed fit for adoption. And so the best way to do that is pay us a visit. So on that website, you can go and make a reservation, start getting to know staff, have some great interactions with birds, feed them, dance with them, laugh with them. It's terrific.
Maybe get bitten by one. That happens.
We'll try to avoid the bites.
This is a great question. Liam, I'm just going to jump in here and answer this one. Someone asked, can I take a QCD from an inherited IRA before 72? That's really interesting. I have to look that one up. I want to say that I believe that would be true because it's an IRA within RMD. That's kind of the rule that the IRS has said. If you're forced to take income, well, if you're going to take the income, you can take a portion of it to gift to charity. But I've actually never seen this question come up before. If you send me an email or something like that, I promise to look it up. That's kind of interesting. I feel like it's interesting. This has not come up before in my work, but I will figure out the answer to that question. That's a neat one. And sorry, and an inherited IRA, for anyone who's listening, is just an IRA that the original owner passes away and gifts to either a surviving spouse or another heir, like a surviving child.
I think there's a couple other questions left in the question and answer box. About how much time are we looking at here? We can probably get a couple more fit in. One of the ones that was listed in here was any amount of charitable contributions be deducted on top of the standard deduction for 2021. I think this is more tax related.
So I said that one more time. I was sort of reading a question.
Yeah, can any amount of charitable contributions be deducted on top of the standard deduction for 2021?
Gotcha. Okay, so if I understand the question correctly, sort of is there a cap on charitable giving? I think that's about right.
Mm-hmm.
There is a cap, and the cap is sort of specific to the taxpayer. It's also specific to the type of gift. The cap is a percentage of AGI, I believe. Maybe it's MAGI. There's influx. These are awfully technical, but that's true. I mean, you in other words, you couldn't gift all of your income so that taxes were zero. The reasons why you probably wouldn't want to do that anyway, but there are limits on a yearly basis, on a percentage basis, on how much you can give to charity. For the tax deduction, you can still gift, and the charities will be very happy for it, but from a tax perspective, there are limits.
And I was just going to break in to remind people, I'm going to put it in the chat just in a moment, but if you have specific questions that you want to address to Frank or Lauren, you can contact Frank at fnapolitano@sensiblefinancial.com. That's available in the slides here. And I'll also make sure those are posted in the chat so you can copy those emails. And questions for Lauren, you can also direct to freeflightbirds, at live.com. And there's more information on her website as well. And I have probably do like one more question from the question pool here. We can kind of start wrapping things up. Investments in DAF, are they invested such that they can appreciate in value over time?
Great question. So this is a short presentation. It's not enough to talk about everything that's in there, but there are two ways of thinking about the DAF for a moment, right? So one is the sort of purely tax, let's make sure we sort of maximize the amount of tax deductions we have by bunching contributions in a single year. After you make that, I think I showed Sally gifting, over a course of 4 years. A cool aspect of this is that you could treat the DAF like another investment account. You could put it in, and some people do this, 100% stock. And you could say, well, geez, if market returns are great, I can double my gift or triple my gift or something like that. But the risk is if market returns are poor, you could give less. But from a long-term perspective, if you thought about doing this and leaving an account for a long time, that's a way to potentially really, really, really get a lot over time. I've seen this with families too. They sit around during the holidays, let's say, and have a conversation with their kids or their grandchildren, and they sort of, gift out $1,000 worth of contributions to families, and have a conversation about, let's look up some charities. Let's talk about what's available in our community, and we can sort of make gifts as families, this holiday season or something like that. It can be a really interesting type of account from not only a tax perspective, but from kind of a long-term perspective.
Okay, so I think that covers stuff that's left over. Again, folks, if you have any more specific questions about the financial side of things, you can email Frank. His email is in the chat right now. You can also save the chat by clicking on the 3-dot menu in the lower side and clicking on Save Chat. On Android and iOS, it might be a separate swipe within the chat window, but on desktop, it's just the 3-dot menu in the lower right-hand corner. You can also get in contact with Lauren at freeflightbirds@live.com or freeflightbirds.org. If you have any other questions, feel free to get in contact with them. Frank and Lauren, thanks so much for coming out today, guys.
Thank you all very much.
Thank you, everybody. Come see Midori.
Absolutely. Please do. She misses people. Take care, everyone. Thank you.